Hello, hello. This is Whitney Emmanuel with your Money Smarts for the day. So today, what I'm talking to you about is a question that I've been receiving from a lot of clients are about bonds. In previous Money Smarts, I've discussed the difference between stocks and bonds, and you're welcome to view that or listen to that, depending upon if you're viewing this or listening via podcast. But what I want to focus on today are bonds and what to do about the bonds in your portfolio. The reason that this is a question is because bonds don't have a great trajectory. And the reason for that is that interest rates are low, so you get very little yield or income from the bonds. And that the growth trajectory is also not great because bonds have had kind of a bull or growth run over the last many years because interest rates have been going down. When interest rates go down, bond prices go up. But right now, we're just in a really stagnant place with bonds. And the thing about bonds is that they're supposed to be the safe part of your portfolio. They're supposed to be the anchor of your portfolio, whereas the stocks are supposed to be the more growth-oriented. But unfortunately, when interest rates do start to rise again, those bond prices will go down. They have what's called an inverse relationship. And so what do you do about the bonds? Do you replace them? Do you hold on tight? One strategy that I have been sharing and implementing with my clients are going more short-term with your bonds because they're less subject to interest rates. So that's one consideration to make. So one, short-term bonds. Number two, there's Treasury inflated protected notes. Those are or also known as TIPS. So those protect against inflation, although you still have some interest rate with those. So you're not solving the problem 100%. Another thing you might want to consider are called structured products, where there's downside protection and FDIC insurance with some of them, or they're insured by the bank that issues them, but you do get some growth potential from the index that they're invested in. So you get growth exposure without the downside. And so that's a really good replacement for bonds. They're somewhat complicated, so you want to talk with me about that, but structured products, and really principal protected notes is what they really are. So that's a good replacement. You could just go the stock route and go with dividend paying stocks and dividend paying stock funds. But the issue with that is that then you're going into a lot riskier of an investment. And if you don't have the capacity or the willingness to take on that risk, that's not a great replacement. They're steadier than speculative stocks, but they're still stocks. And so you're still taking on a lot more risk by going that route. Another option, of course, is going with cash. You can't lose cash, but the issue with cash is that it doesn't keep pace with inflation. Experts are assuming that inflation will go to about 2.52% after the short run of high inflation with our supply-demand issue. So cash is not going to keep pace with inflation, especially with this short-term high inflation period that we're in. And so if you want to keep pace with inflation, cash is not a good place to be. It's a good place for safety, but not to keep pace with inflation and to grow your money. So all those items are options. Another thing to consider are alternative investments that you produce income from. One example is a real estate income trust or a REIT. But if you do have a lower capacity for risk, these are not invested in the stock market, but it does have some other risks. Investing in real estate has, of course, many risks, as many people know from the Great Financial Crisis in 2008. But it is an income-generating product, and it's not publicly traded, so you don't get the same market volatility that you would get with a traditional stock. And you generate rental income of real estate that you don't actually actively have to manage. So that's something that I can help facilitate. Those are some options. One other option that some people, there may be some misperceptions about, but it could be a replacement depending upon your financial situation, is whole life or index life insurance. Generally a good option if you do want the death benefit, but the thing about these is that they do have some guarantees against loss, and it grows tax-free if you're investing outside of an IRA or a 401k. So I do like that, not only for the safety portion, but also the tax benefits of investing in that. So please contact me with any questions that you have specifically on this, but those are just some examples of things that could replace a portion of the bonds of your portfolio if you are concerned about the outlook of bonds in the market environment today. Of course, none of this is guaranteed. And of course, I have to say that, past performance doesn't guarantee future results. However, these are just some strategies to discuss with your financial planner, and I would love to have a conversation with you. So again, Whitney Emanuel here with your Money Smarts for the day. Have a wonderful, wonderful rest of the day. Bye-bye.